What is up, party people? This is your boy Nico here. Now, today I'm back with another epic episode of my podcast. And today I'm going to do something a little bit differently. I'm going to have a video podcast. Obviously, you're welcome to listen to it audio. You're welcome to just watch it on YouTube, whatever you feel comfortable doing. But what I plan on doing today is walking through my brand new multifamily deal analyzer called the Multifamily Deal Blade by Small Axe Communities. So, what today's podcast is about is showing you the ins and outs of this particular multifamily deal analyzer that took me 2+ years to finally make. I spent a bunch of money hiring people to help me up front at first. They wrote a bunch of stuff. I had version 1, version 2. I was up to version 20, seriously. And I really didn't push this out because I didn't feel comfortable yet. Today, I am ready to push this thing out. And today, what I'm also going to do is just walk you through the ins and outs of this. I'm going to show you, if you're watching on YouTube, exactly what it's going to look like because this is the actual template. And if you're listening on a podcast, you're going to get a lot out of this as well, because I will talk you through how to use it, what metrics it tracks, how it can hedge against risk, how it can help a brand new investor, a seasoned pro, cut through the noise and get to what matters most: cash flow, risk, and returns. All right, when you get my multifamily deal blade, when you get this thing, you're going to start it by opening it up, and you're going to be right here on the instructions page. On this first page, it gives you where to start. It's a quick little intro saying thank you for downloading this template. Then there's a disclaimer, and then there's how to use this template. You're basically going to start on the property info tab. That's the tab that's going to be first, and then you are going to be editing information on that info tab. You go to Crexi, you go to LoopNet, you go to a broker, and you get a marketing package. You download the OM, the rent roll, and the T12. All you really need is the rent roll and the T12. If you're going to get real skimpy, you just need a rent roll. And you start inputting information. That information goes on the grayed boxes, which we're going to look at right now. If you're looking on the screen, these gray boxes are where you can put information in. The rest of the sheets are protected, okay? I protected all the sheets so you can't mess anything up if you were worried about doing so. Very easy to unprotect. You go to review and you unprotect it, and then you can edit anything on the page. But right now, how I have it set up is you can only edit the information that is supposed to be edited. So whatever is grayed, you can change and edit. For example, the property name, street address, zip code, year built, then the unit mix, right into the current average rent, right into your pro forma. Okay, so this feeds a spreadsheet. You put your purchase summary. On the purchase summary, the asking price, and then your purchase price, which is obviously oftentimes different. You get the CapEx reserves per door. Typically, you just leave that at 250. Rehab per door, I started around 8 to 10 to maybe 12,000 per unit. And then we have the number, the tax and insurance escrow. You could choose how many months of tax and insurance escrow, or 0 if you don't want to raise that up front or bring it up front. An acquisition fee if you're doing a syndication. If you're not doing a syndication or you're doing a JV, you could still use an acquisition fee if you want, but you don't have to. Then there's the operating reserves of how many months you want for this to tally. It could be anywhere from 0 to 11 months of operating reserves. I typically recommend 3 months of operating reserves, and that calculates from your pro forma sheet. It's going to gather how much money you're going to need for year 1, let's say, and it's going to calculate 3 months of that. And then the closing costs are anywhere from 2.5% to 3.5%. I have it set right now at 3.3. You can change that if you want. Let me go back to the instructions sheet. So you follow the flow of this. It's going to give buttons at the bottom of every tab, and it's going to show where to go next. And it's going to take you to the next step, so you don't have to worry about where to go next. And then I protected it again by default. So you could simply unprotect each sheet. Very easy to do. You go to review at the top, click unprotect sheet, done. There's no password for it or anything. I give you on this instruction sheet as well some quick rules of thumb. Okay, 1% rule, cap rate check, DSCR, etc. So these are just basic rules of thumb. You always want to verify stuff. So then I'm going to give you pro tips on the right side as well. Always stress test for vacancies and unexpected expenses that can happen. Look beyond the IRR, focus on cash flow first, okay? Underwrite conservatively with higher expenses than you think, lower income growth than you think might happen, and verify rent comps for yourself. Don't trust the broker's OMs. Verify taxes and insurance, the biggest expenses that we have. Do not trust the broker's OMs. And every market is very specific, and every municipality is very specific on how they calculate and even recalculate taxes. So you have to make sure you call the appropriate people on that. So taxes and insurance, very important. Markets and property classes can vary greatly. So this is just reminding you some pro tips to consult a local property manager or somebody that's professional. Okay. If you don't know or understand something on the sheet, you can just click this link at the bottom of this instruction sheet. That's to go to my Facebook group that I literally just created. So it's going to be brand new, and I will be there helping people answer questions on this thing. And it is just facebook.com/groups/buy buildings, one word. Okay, that is the group. So facebook.com/groups/buy buildings. You can join my community and we can answer questions and pose questions and talk about deals and anything else for this specific multifamily deal blade or multifamily in general. There's no cost involved with it right now. I'm just getting people in so we can feed this thing and start making moves happen. Now we go back to the property info tab. On the top of it, you can set the split. You're going to do a 5% preferred return, 6, 7, 8, whatever preferred return. You input that here. And then the split thereafter, LPs get 70%. In my case, 30% to the general partnership team. And now, if you do not understand what I'm talking about, if you don't understand syndications, that's okay. Go to my website, smallactscommunities.com, download my multifamily credibility kit. That'll get you started. And if you want to book a call with me, I can get on a call and help you. Or if multiple people are trying to get on a call with me, maybe I'll do a webinar kind of explaining how to do multifamily investing in general. I also have a course coming out, and I might even be pre-funding that. So just stay tuned for that. So you click the bottom, take me to income and expense. Guys, this is beautiful. So now the next thing you do is income and expenses. Okay. I'm actually going to move this investor summary to the end because that's where it makes more sense. So we start on the property info tab. That tab is done. We click take me to income and expenses. Now on this tab, you go to the T12 and you just pull out all the information. The gross potential rent was already pulled for you. It's done from the property info tab based on what you input here. Now on the income and expense tab, we have the utility reimbursement, which you input from the T12, other income from the T12, taxes, property management, asset management fee, et cetera. Insurance is typically, you're not going to see an asset management fee. I've never really seen one, maybe a couple of times on a T12. So don't even worry about that. Just put in what you know. Insurance, it should all be on the T12. Trash removal, if there is, it's not always on there. Sometimes it's bundled into utilities or contract services, or sometimes it's not even there because it's included in the taxes. You should just get familiar with underwriting in a specific market, and you will get to know the nuances of that market and what is included in expenses, what is not, what is the rule of thumb or normal for expenses, what is not, etc. When you're filling this out, you're done. Just complete it, literally copy from the T12. Then you click the button on the bottom, take me to financing. We got to figure out how we're going to structure this thing. And I currently have it with a stabilized loan. So this is a fixed rate loan. It is not bridge. It's not hard money. If you're using bridge or hard money, there's a simple drop down. You just click on bridge. Very easy to do. And I'm going to do that in a minute. But right now, I typically underwrite, and you should do the same with a stabilized loan. Anywhere from 25 to 40 or even 45% of the down payment you have to come up with, depending on the specific deal. And if you are coming up with a metric that is showing the DSCR as being too low, you might have to bring more money to the table. That's the simple fix, although it sucks to bring more money to the table. If you're coming up with a DSCR of high, then you can reduce that down payment. So I like to start with anywhere from 30 to 40%. I typically just leave it at 35% for all my deals, and I underwrite like this. I figure I have to put down about 35% of the capital. Now, going back just quickly, in case you were curious about a DSCR, the debt service coverage ratio, the lenders look for this. So the lenders are going to need to see a debt service coverage ratio of at least 1.2, maybe 1.25 or 1.35 of the NOI. After the income and expenses, you get your NOI. Now, that NOI is not yours to keep. Debt has to come out of that. You have to pay the debt first. The money goes first to them, then it goes to the investors, then whatever's left over goes to you, the owner, operator, the GP, the general partner. So when a bank is looking to service a loan, they need to see that the NOI is more than the debt service. For a quick example, if you have $125,000 NOI, they're going to max out at $100,000 in debt service, meaning your mortgage payment is going to be $100,000 a year maximum, and then you get to keep $25,000. That's the minimum threshold. They need to see at least a cushion of 25%, okay, typically. Very easy to calculate because the spreadsheet does it for you, and most spreadsheets do. And then here you have the equity stack. It's going to tally all this stuff up for you. There's only very few inputs. I tried to minimize all the inputs on each tab so that you don't have to worry and you can just kind of go through the flow of how we should be underwriting deals. You can change the interest rate. And again, years ago, it was 4%, 3.5%. Today, you're looking closer to 6 to 8%, usually somewhere on the 6 and 3/4 or 6 to 7.5 rate. Is it going to be interest only? Maybe you might be able to get some interest only. That could be 0, 6, 12, 18, 24, 36. It could be the whole term of interest only payments. That means you're not paying anything towards the principal. You're just paying the interest on that. That could be beneficial, especially for a construction project or a heavy renovation project. And then you have interest only months. You can put that in yourself. And then the amortization is typically going to be anywhere from 20 to 30 years for a commercial loan. So 20 years is probably the minimum. 25 is standard for a local bank, a community bank, and certain agencies will go to 30%. And even certain local banks will do 30-year amortization rather, not 30%. Is it a recourse loan or non-recourse? You can check that. And then the number of payments per year, just check that. Leave it at 12 is probably the standard. Now, I also have the ability to add a second loan on top of this if you have some sort of other type of financing, meaning you might have a mezzanine debt, or maybe you're getting a line of credit or some other second loan. You can add that here. Again, if we're going to do stabilized or bridge, we can change that to bridge, and things are going to change a little bit. You're going to have some of the rehab paid by bank, and you could input that number there. And that changes the structure of the deal a little bit. And every scenario is obviously different. So you just have to know what you're getting into, what type of loan you're going to use. Very, very simple. Again, I tried to really strip this down to make it very simple for you as the user, yet extremely functional and powerful for the end result of analyzing deals, analyzing risk, ensuring for cash flow and returns for your investors and yourself. I keep saying your investors, but you can use this for yourself. It's not just for a syndication. You could do this with a JV. You can use it for yourself if you're going to buy it for yourself. It's just to analyze a property and how well it's going to perform. Now we click to the next tab, which is the pro forma tab. And now we're going to build our pro forma. The pro forma is going to be built on 10 years. Okay, that's the maximum that this goes to, because typically you're going to own a property for a maximum of 10 years, especially if you're syndicating. You don't really go beyond 10. You typically offer a syndication from 3 to 5, 7 years. 10 is the max. And if you're buying this for yourself, you only need a 10-year pro forma to see how it's going to perform. You're really not looking, oh, well, in 2040, I know that I'm going to be making this much if I keep it. No, that's not really how it works, because again, you're going to have to really adjust your game plan every few years. You're going to have to inject capital for the capex tsunami that could happen, et cetera. So we just model out a 10-year pro forma maximum, and you're going to adjust your sale based on when we get to the exit strategy tab, which we're not there yet. So right now we're building out our pro forma. What this page does is it populates from the income and expense from the T12 that you put in. You input that information, it populates it here in column E, and then you're going to begin to put in your inputs in column G, which is year 1. So year 0 is takeover. Year 1 is when things start changing and you start implementing your business plan. Now, whether 0 to 1 is 12 months, whether it's 11, 10, 2 months is something different. But year 1 is when your pro forma starts taking shape. Here we go. You're first going to look at these operating costs. Property management fee. What's the fee? My property manager, because we have a great relationship and he is on our team, charges 6.5%. For smaller deals, it could be 8, 10, 11, 12%. Okay, you got to just know, and you're going to input that. For a very large deal, it's going to be 3%, but then you're going to have payroll. So just know your expenses a bit. And if you're a little confused, a pro tip would be to find somebody with CoStar access. It could be a broker. Give them an address of a property that you're looking at. Have them pull what's called a CoStar report. Very easy to do. So when you pull that CoStar report, it's going to give you a ton of data, including property management fees. It's going to include real estate taxes. It's going to include all the expenses and the typical cost for expenses for running a multifamily apartment complex in that area. Now, this data is awesome, and it's awesome as a benchmark starting point, let's say. But there are so many nuances. You don't want to heavily rely on that, but it's a great starting point. Now, you just go down column G, input the taxes, the insurance, the trash removal for what it's going to be. Again, this is pro forma now. So taxes go up, guys. They don't go down. Insurance goes up usually. It doesn't go down. You have to make sure that you get actual quotes for these things. And you go down the line and just fill it in. Now, back to the top. this is very important. On year one, annual rent growth. So I have it set right now for the annual rent growth, which you can change 3% year over year. It's very market specific, very market cycle specific. So be careful. And the annual expense growth of 3% year over year. This is cyclical as well, depending on market conditions and economic factors and things like that. I just leave it set at 3 and 3. However, every deal that I go into knowing that there is upside on the rent. However, we get that upside. Sometimes it's an operational inefficiency where we have to fix the management. Sometimes it is a physical inefficiency where we need to renovate the units. So just be aware of what type of value add there is for the particular property that you're getting into. Now, we're going to look back once you have filled out the property info tab. Your pro forma rent is what you filled out, and that feeds over to this pro forma tab. And right here, you're going to see populated here the average current rent based on today's rent roll that you input from the rent roll. Then the target monthly rent. This is what we are targeting in our pro forma. So this builds off of our pro forma, what we know the rents should be. And then I have a little indicator here right underneath that in cell D10, which is the average affected collected rent monthly, which is important. I don't feel it's realistic to push rents more than $100 a year. I don't think it's possible to increase rents more than $100 a year. Or you can consider it a certain percentage per year, whatever it is. You have to be careful with how much you're increasing. For example, if there is a $500 rent bump and you know it and it's valid and it's true, it's proven, you're never going to achieve that $500 rent bump on average. Average rents are never going to increase $500 throughout that 1 year. It is extremely hard to do that. That means getting rid of all the tenants, which is very challenging to do, placing brand new tenants at the top dollar and getting 100% occupied. It just doesn't happen. So there are two methodologies with rent increases. Method one, let's say you have that $500 rent increase. You're going to spread it out over a few years, maybe $100 or $150 per year. And to do that, you just go to the top row, the annual rent growth, and you increase it as you see it increasing to however many percentage points you need to get that number of the $500. Now, bear in mind that there might also be year over year some organic rent growth. This 3% that is here on top in row 5, showing an annual rent growth, is organic rent growth. Historically, in most good markets, 3% has been the norm for organic rent growth. So, yes, you could factor that in if you have $500 rent increases that you know can happen today. Then, over the course of 3 years, you burn off that rent increase. There's also another 9%, 3, 6, 9% that you could potentially capitalize on. Just throwing that out there. I'm not saying to do that, but that is a possibility as well, depending on the market, obviously. Now, the other way to look at this is to burn off the loss to lease. And that's basically what I do. So what I do is I bump up the rents in year one, the annual rent growth. I shoot it up to 20, 50, 30, 100%, whatever it is. And I can show you an example of one in a second here. I bump that up to a full capacity. However, I then go to the concessions, non-revenue units, uncollectible rents, and loss to lease, which you're going to see in row 15. And I burn off the loss to lease. So loss to lease is the delta between market rents, what you can be getting versus what you are getting. So again, it takes a long time to get residents out to increase rents. It really takes a long time. There's a couple strategies to doing that. You can put everybody on a month-to-month lease, give everybody notice that, hey, we're changing everything to a month-to-month lease after your lease is due. And you can either buy into the new rate of $500 more, or you can leave. And if they leave, you have to turn the unit and you have to make it clean and ready for the next person. And then you have to market it and you have to rent it at that new price point. So those are the two ways to do it. You can change the pricing upon lease renewal, and some people will buy it, some people won't. $500, depending on the rent increase, it could be huge. Some people are okay with it, some people are not. Or you can inform people that you're not going to renew the lease and you can just get rid of them and then turn the unit, market the property at the new price point, and get a new resident or tenant in there. So let me show you the example of what I was talking about. Here's a quick example of how I like to burn off the loss to lease rather than burning off the rent increase, which I feel is a little bit, it's just a strategy that I'm more comfortable with. So this property in particular has a 25.1% increase, and it's very easy to calculate. So if the current average rent, which was already auto populated for me, is here, and the target monthly rent, my pro forma is this 1250, I have to get there by adjusting this number. So I adjusted this percent to get 25.1% to get that 1250. Okay. Now what happens is you have to back into that number by ensuring that you have enough vacancy. I have 10% vacancy, which I feel is fair, burning down to 8 and even 7% by year 4, which is very fair. And now this loss to lease section, concessions, non-revenue, loss to lease is 10%, which makes my average effective collected rent monthly 1125. And I have this in red right now. This is in red because it's typically more than I like to do for a year. Again, you can't really get more than $100 a year. So let me change this to 12%. And it's still a little too high. So 13% loss to lease gets us in the range of where we need to be. And then we burn it off. Then year 2, maybe we're at 8% loss to lease. Year 3 by 3% loss to lease. And then 2, when we're stabilized, depending on the market, you're going to be somewhere between 1 or half a point even and 3% loss to lease, concessions, uncollectible rents, delinquency, etc. So just burn that off. That's the way that I like to do it. And then what happens here at the bottom, let me go back to the actual spreadsheet. At the bottom, things are going to be calculated for you. For example, you get your NOI after your CapEx reserves. The CapEx reserves I tend to put below the line, which is also important for accounting purposes. And you get your NOI and then the principal reduction from the debt service, because debt service takes out the money first, right? And then you have some syndicator accounting, which I always have. I have to pay for an accountant to do our taxes, which is extremely important. And then it goes down to the member's preferred return. That is the next payment in the capital stack. First, income in, expenses out. That gets us our NOI. Then debt service comes first. Then our preferred return. Then cash flow to the investors. If we beat all of that, then the general partnership way at the bottom gets to partake in some of that cash. All right. So this tab right here, the pro forma tab, is huge. This is where you're going to do a lot of finagling and adjusting to make sure the deal is working or not working and change things. Also, sometimes you get to bill back the residents. For example, if the landlord is paying for water and other utilities, you can charge a fee. And that's called RUBS, or a utility billback, ratio utility billback system, RUBS. We have it set right now anywhere from $15 to $65 per unit per month. And I'm giving you a quick RUBS input right here. You could just put, let's say, 35 to 50 bucks if you can charge RUBS. And remember, RUBS legally can only pay back 90% of the actual bill. So if you have a bill for $10,000, the RUBS can only equal at full capacity $900. All right. So just keep that in mind. It's got to be 90%. And that's your threshold for it. So I give you a quick RUBS input. Just punch that number and right there, keep it simple. If you want a full other income and RUBS calculator, I have at the bottom. Just look, it's all grade. You can adjust these as well. And this helps you factor in total other income and the total RUBS. Now we click on Take Me to the Returns tab. And this is where it's done for you. It's built out the returns. And it's going to tell you the total return investment for the members. This first chart is for members only. Okay, so this is for the LPs. And this is huge because this is where their metrics are shining. And then we have right here in the bottom of this chart, it's got the total return on investment, the IRR, average cash on cash, equity multiple, etc. On the next chart, it's going to show the manager cash flow. If the manager, me, the general partner, me, you, if we are participating in any of this capital as well, this is going to lay it out for you. I have the ability to have 8 different partners on your GP team. And I think that's sufficient. So scrolling down again, we have the project level cash flow chart, which is here. You guys, you don't have to look at any of this if you don't want to. I made it real simple. You could just look at the investor summary in a minute, but this is important in my opinion. And I love looking at charts and sheets like this. So maybe you will too. And then I have a copy and paste members return based on a specific investment. So I have it set right now for $100,000, and people who are going to invest will either invest $50,000, $75,000, or $100,000. You can adjust that number here, and it's going to break out for them exactly how much you're projecting that they will get based on that investment amount. And for this particular chart, which you will, again, can just copy and paste to share with somebody, has the total return on investment, cash on cash return, IRR, AAR, the average annual return, and the equity multiple. These are the metrics that investors look for. These are the ones that are very important for them. And below that, on this very long returns tab, we have the general partnership split. So what I built in here is an equity split calculator for you and your team. You have to first go through and set the percentages for each category, each bucket: sourcing, contract, due diligence, and closing. I leave it at 20 to 30%. Risk capital, EMD, DD expenses, 20 to 30%. The capital raise, 25, 30%. The key principal or the balance sheet guarantor or guarantors, 5 to 10 to 15%, depending on the deal. Asset management, 30, 40%, whatever it is. And then I gave you a category for other. And that's going to total everything. It's going to equal 100%. And that's going to give you your calculations here for the general partnership team, how much of the general partnership you own and your team members own, and how much of the entire project you own. That's going to be all calculated for you, and it's going to give you some indicators like right here for the capital raise. It's going to give you a target raise up top. And then if it says set at 0, it says start raising. And then it's going to say keep going. You're almost there. It's going to encourage you until you actually make the final capital raise. So I really like this page as well. Really useful. Again, you could add 8 partners. Just put the people's names here. It'll auto populate for you. Nico's here. Bob is there. Billy is there. And then look, you see at the bottom, it just auto populates things for you. And then you start adding in what people are doing and how much percentage for each person, etc. So this is all wonderful. I love this. It's done for you, and it is cool. Moving on. So now we get to the bottom of this tab. You can either click to the tab or click this button, take me to the exit strategy. How are we going to exit this thing? Very important. Are we going to refi? I always have it set to NA, not applicable. Right now, in today's day and age, people are, I guess, hesitant to model in a refinance. However, as my last episode, you heard, it is very possible to model in a refinance, but we don't model it in our pro forma necessarily anymore, unless it's very compelling to do so. But because there's uncertainty in the interest rates, and people kind of raise an eyebrow of like, well, is that even possible? So just stay away from, in my opinion, modeling in a cash out refinance. You should just model something like 5 to 7 years or 3 to 7 years. That's typically what I do. So disposition end of year, set it right here. Again, I typically set it to 7 years, 5 to 7 years or so. And that depends on a lot of things, but you're going to set it yourself. The cap rate refinance, if you're going to do that, the refinance LTV, if you're going to do that, interest rate, that's way too low, obviously. We're going to set that at 5%, let's say 6.5% rather. That's what it should be. Amortization, 30, 25, whatever you're thinking. Interest only in months, right there, boom. And then the refinance cost is typically anywhere 2 to 3%. And then back to this disposition, the sales cost is typically going to be about 4%. If you're doing a capital transaction fee to the manager, you put that in there. So all of this stuff is built for you as an owner, as an operator, as a GP, or even as an LP to analyze deals to see how a property will perform based on a pro forma. So how will the property do based on your pro forma? Click on this, take me to the investor summary. This is where everything auto populates into a nice, beautiful sheet that you can easily wrap your head around. And I really love this. It took me a long time to figure this out and build this out the way I wanted. Literally, it took me months and months of changing things and adjusting, and I finally got it right. So let's talk about this. This is one of my favorite pages on here, my favorite tabs, the investor summary. And I'm going to pull up an example of one. So everything that you had done so far is just going to auto populate into here so you can display it to people. And let's take a quick peek at this one. We're going right over now to the investor summary tab. Here we go. So this one is done. It's auto populated. Now we're looking at this particular property. The IRR is 13.6. AAR 17, etc. You see these metrics here pulled up for you. Year 0 cash on cash. That's important to look at as well. Does it kind of cash flow year 0? This one's very tight. That's okay. You just have to be upfront with your investors about what it is and whether or not their risk level is good with it. Because if you take a look at this, the equity multiple is over 2. That is awesome. And honestly, it depends on your type of investment strategy and thesis. Each deal is going to be very different. But I really like a good equity multiple. I like a good average annual return. I don't care so much about years. I don't care so much about getting distributions. I obviously care about the deal performance and whether or not you're going to be underwater, which is very important. I don't care about living off of the cash flow, but cash flow is a safe haven. Cash flow is a cushion against any issues that could arise. So I do need cash flow for the deal to perform. I don't need it to live off of because I don't have enough money invested for me to live off of the cash flow. My main purpose of investing, or my strongest purpose of investing, is cash flow first for safety and security of the deal. Equity multiple or overall return, average annual return, is next for me because I really need to get the highest bang for my buck. That's my investment thesis. And then you go down, there's risk and operating metrics and value and market fit. And it really, what I did was I spent a lot of time figuring out benchmarks and what is good and what is not good and how deals should be run and how they shouldn't be run, etc. And I came up with a little screening result. And this gives you a test. So this has 12 items passed, 2 items failed. I put 2 remaining just to not be so negative. That's 86% pass rate. This now says, great job. This deal meets our benchmark. And some of these benchmarks are my particular benchmarks, which are already populated in here for you. But a lot of them are done by you on this property info tab. So back to the first tab, property info tab. Here is the deal readiness comparison. This is your criteria. Average cash on cash. Mine is 5%. Yours might be 8%. A lot of deals are going to fail that. IRR for me is 12%. AAR 12%. Equity multiple 1.5 minimum. If we're going to do our refinance, the capital returned 25% minimum. It doesn't make sense to do it otherwise. Debt service coverage ratio 1.3. Okay, so and then on the right side, the current deal metrics of what this deal is showing. Again, this is all auto populated for you. This will be done for you. If you want to change this, you can change the criteria to fit your particular needs. These are preset with my needs. Okay. And then there's a few more metrics here. For example, does it beat the 1% rule? Yeah, 1.11. Can the tenants afford the rent? Yes. And you have to do that by inputting the median household income here. You have to input that yourself. You get it from FFIEC or whatever, GeoMap, and you put that median household income. And if they can afford the rents, it's going to say yes. If they can't, it's going to say no. What is today's market cap rate? Is it 5.5%? Is it 6.5%? Is it 8%? You put that in here, and some of the metrics will be factored in based on here. For example, your exit cap assumption should be more than the market cap, because today we cannot say that the market is going to get better or stronger 5 years from now, 3 years from now, whenever we sell. This exit cap assumption is crucial to be higher, typically 10 basis points or 0.1 higher than today's market cap rate. As a quick example, if you're going into a market cap rate of 6%, you are going to expect to exit at 6.5% 5 years from now, just as a rule of thumb. Okay. Obviously, there's many nuances to that, but typically you want that exit cap higher. And if it is higher, it passes. All right. And then we have an all-in purchase cap rate, boom, and then the stabilized cap rate, boom. You want to see a good spread of at least 0.5 or 50 basis points, which I have here on this stabilized cap rate spread. Honestly, I look for more. Instead of 0.5, I look for 200 basis points higher, at least. But you could put in your own criteria or leave it as is. Now, on the investor summary page again, you're going to put in some loan terms. Are you using a local bank? Is it fixed or floating debt? What is the loan term, the balloon payment? When does that due? 5 years, 7 years? If this is going to say 2 or 3 years, you might be in trouble. Investors might be like, what the heck, man? This deal is coming due in 3 years and the loan's coming due. How are you going to pay it? Just have your ducks in a row. Now, on the business plan, the total capex per unit, you had already input in the property info tab and it auto populated here. And it's going to have a conditional formatting. If it's less than like 8,000 or something like that per unit, it's going to turn red or yellow and say, hey, do you have enough money in budget? If it's over 10,000 or 8,000 or something, it's going to say great budget. I recommend having some money in reserves for capex down the road. If you're holding a property for 5 years, you need to have money to do turns 3 years from now. Okay, so just keep that in mind. And it's oftentimes not a possibility to use the cash flow from the property for capex. Sometimes you can, sometimes you can't. Here you can input some interior upgrades and exterior upgrades summary. And that's it, guys. You present this to your investors. Oh, There's a picture right here on the top left. This should be the image of the property. There's a little note here that's going to tell you what to do. To replace the image, select and delete it and insert picture from file and resize it to fit. Now you have a beautiful sheet that is ready to be printed for investors or downloaded as a PDF for investors. You can share this with your investors. This can be a one-pager. This could be a tear sheet. This could be whatever you want it to be. And this is really, in my opinion, years and years of experience and work that went into doing this. This is my version 1, my finalized version 1 for my multifamily deal blade. Okay, my party people. So if you want this spreadsheet that took me 3 years in the making, tons of trial and error, tons of experience of actual deals, doing deals, analyzing deals, operating deals with this specific deal analyzer, it is now finally ready to launch. This is the official launch of the Multifamily Deal Blade. Here we go. If you want it, go to smallactscommunities.com, my website, /deal analyzer, smallactscommunities.com / deal analyzer. Or you can find the link in my bio to get this thing, or you could just DM me the word spreadsheet and I will give you the link. And let's go, guys. Stop guessing your numbers. Stop the headaches. Stop fiddling with the weird spreadsheets that are out there. This tool that I created after literal 3 years of grinding and grueling, I couldn't believe how long it took, whatever. This tool will make you fast, confident, and dangerous in this multifamily space. Grab it today. Start analyzing deals like a pro. And just know that I am here to help you. I will give you access to a Facebook group where you can pose questions, get questions answered about this deal analyzer, but not only about it, also about deal analyzing itself, also about multifamily itself. So if you're looking to grow and expand yourself and your multifamily journey, you need to join the Facebook group. You need my deal analyzer. Let's build a community together. Let's build a tribe that takes each other farther and farther and gets each other rich as heck. Let's crush this space. So again, go to smallactscommunities.com deal analyzer to get my multifamily deal blade. DM me the word spreadsheet or just ask for it and I'll give you a link for it and find this sheet. And guys, there is so much more to come. You need to get started right now. Jump on this spreadsheet, buy it, share it, give it to somebody as a gift. I don't care. And there's more to come. I'm going to give lessons for it. I'm going to have videos, instructions, video walkthrough. I'm also going to be doing a full entire recorded course on how to invest in multifamily. Everything you need to know from 0 to 1,000 doors. Okay. This is how you guys are going to grow. I need you guys to start working hard. I need you guys to really jump into this space, get this deal analyzer. I love you guys. Let's rock. All right, and that's a wrap, Small Acts community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.